go through the Russia outlook here, and for about 10 minutes, and then hand it over to Central Europe. So COVID-19 risks. Unfortunately, new cases have been quite elevated for the last couple of months, about 2 to 3 months here. Now, we should see them moderating going forward a bit. However, they will stay elevated and likely even accelerate higher over the course of the winter. Deaths are also at extremely high levels. A key point here is that could this have an impact on the elections? Our expectation is no, but it's something to pay attention to here this coming weekend. If we see higher protests at the results, particularly when people have been annoyed at the mandatory vaccination campaign. That said, regional leaders for the last month have relaxed compliance and implementation of QR codes and mandatory vaccination schemes, which we anticipate will come back after the elections. When the political calculation for the Kremlin changes, we could see the government much more intent on trying to force vaccination of the population. And in addition to that, very critically, potentially increasing even restrictions to protect the healthcare system. So maybe having nighttime curfews in certain parts of the country for a temporary period of time, or other various measures to protect the healthcare system once the elections are over. So pay close attention to that, as it, of course, would impact market outcomes. As mentioned, energy prices are quite positive for the Russian market, which is good. You can see our expectations here, which is going to very much help the government budget and therefore spending across all of next year. And the ruble will continue to perform relatively strongly. This is our base case expectation in the event of no significant U.S. sanctions, which is our expectation. The impact of these dynamics, of course, on the market is that we're seeing inflation levels quite elevated, ending the year probably around 6%, which means as we saw this week, saw last week, a hike in the interest rate. We're going to see another hike in the interest rate next month. We're going to be approaching 7% by the end of this year and into the beginning of next year. That's elevated compared to where we were a year ago, but historically that is not particularly high, and that should not have a major impact on lending in the country. In terms of ruble performance, again, we have revised our expectations for the ruble as well as other currencies in the region, partially because of the very strong performance in the first half of this year. So you can see continued improvements into next year as well on average. So general stability, if not outright appreciation of these currencies, helping, of course, planning and predictability in the market. Compared to the euro, we're going to see a bit more euro strengthening next year against the dollar, and likewise, therefore, even if with the ruble performing generally strongly, it is going to still weaken moderately against the euro. The overall impact on prices is that despite this appreciation pressure in Russia, we have seen prices quite elevated and sticky high, which the central bank is responding to by raising interest rates. A lot of this is driven by food inflation, of course, which really cuts into consumer sentiment. And that's why we're seeing consumers actually reporting in surveys feeling that prices seem like they're 16, 17%, growing by 16, 17%, right? And that's what they're observing in stores, much higher than what's reported. The problem here is that expected inflation by consumers, they feel like it's quite high, 12, 13%. However, there's a significant gap between what they're expecting for the future compared to what they're seeing today. The problem here is that it makes it very difficult to raise prices on consumers because this signals price sensitivity. This gap here signaling that consumers are expecting prices to slow down and they are not willing to absorb or able to absorb considerable price growth going forward. So this will create some pricing dynamics again with all that supply pressure on prices for the next year, matched with rising consumer sensitivity. It will be difficult. It will put pressure on your margins. It will be difficult to raise prices on consumers considerably into, I would say, across all of the first half of next year. Fortunately, consumer credit, despite the fact that we've seen higher interest rates, despite the fact that we've seen risk premiums higher, in July, we're going to see another increase in risk premiums in October. Despite all of this, we are still seeing consumer credit accelerating this year and will continue to grow at more moderate levels in 2022, but will still grow quite solidly after clearly solid performance in 2021. Absolutely central to sustaining retail sales, which will be pivotal. The labor market has, generally speaking, as the Ministry of Labor has already reported, recovered back to pre-COVID levels, and unemployment is actually lower than pre-COVID times. Retail sales obviously sustained by that, plus a revival in real disposable incomes in the first half of this year, which is helping drive obviously a lot of that demand sentiment, fortunately, which is going to continue. And with greater government support, we're going to see real incomes rise by probably 2 to 3% next year, compared to earlier predictions of just 1 or 2%. Combined with that positive credit story, lower unemployment, we should see consumer sentiment, which you can see here, reviving more strongly. Consumer sentiment took a big dip in July because of the implementation of the QR codes in many regions of Russia. With the relaxation of that, we saw it pretty swiftly recover back in August. We anticipate September should be quite strong as well. But of course, pay attention to the price sensitivity amid high inflation in Q4, potential lower lending, and then also the implementation maybe of QR codes to try to force vaccination across the country. That in Q4 could weigh a bit on sentiment, though generally speaking, all the other dynamics are going to continue to drive up consumer sentiment going through all of next year. And in terms of tourism, we've also seen domestic tourism rising dramatically, replacing a lot of that foreign travel. We anticipate that, yes, there'll of course be a return back to foreign travel next year, but some of these patterns are here to stay, as many Russians discovered new parts of their country that are cheaper and easier to access, potentially, than going abroad. So we should see continued solid domestic tourism into next year as well. So something to pay closer attention to as we see international tourism arrivals pick up, matched with, of course, domestic tourism helping drive the recovery. Looking at business confidence, though, we are starting to see, again, some of that moderation of opportunities in the market. So business confidence has improved dramatically beyond even pre-COVID levels, but we aren't going to see it accelerate, unfortunately, as some of the restrictions we saw in Q3, plus, of course, rising price sensitivity from the very high costs that are continue for the next year. This, unfortunately, is going to start holding back now, after a strong recovery of businesses across H1, start holding back some of that sentiment going forward. Manufacturing is still very high, but that cost pressure is definitely weighing on businesses' outlook. And mining is going to continue to improve as OPEC restrictions are loosened consistently every month. But you can see this in PMI. Under 50 in PMI surveys indicates a expected contraction in demand in the coming month by businesses in services or businesses in manufacturing. So you can see this continual slowdown in both manufacturing and services until we've seen a contraction in both as of August data. So again, this does signal for the coming months a moderation now in some of that expectations from businesses. All of that said, bigger picture, if you look on the x-axis here, on average, through all of last year through the first quarter of this year, we did see clear improvements across most of a lot of the major industries, and critically, investment levels are quite high across most of the industries as well. We will see continued improvements in both investment and industrial production for most of these categories. So that should, of course, continue to drive greater expectations. The key point here is that agriculture, unfortunately, one of the larger sectors in the country, has been quite mild as a result of weather conditions. Unfortunately, that will hold back some demand and maybe create some price sensitivity from customers in that category. Budget spending, though, has been extremely positive. So we've seen through July an 8% increase in budget spending. Now you have to remember that the original budget for this year implied a decline of 5% in spending for 2021. Instead, we've seen actually a nominal increase, at least, of 8% growth. So beyond expectations, thanks to revenues being up dramatically. Total revenues up 31% in this period, with energy revenues up 60% year on year, helping drive a lot of that increased spending, which you can see quite clearly here, impacting the national economy, state administration as well, which is critical to salaries since there are so many workers who work directly for the state. Reliant on that helps drive up incomes quite consistently. Plus social spending even rising as well, which social spending was supposed to be maintained in the budget as it was. So looking ahead into next year, we are seeing already plans, they haven't released the budget, plans to increase spending by at least 1.5 billion more rubles than the initial plan was in place. So we're going to see further ad hoc spending increases with high energy prices next year, again, helping sustain demand and investment across the economy. And of course, before the elections, Putin announced a nice handout to families and pensioners and to the military. Again, helping sustain some of that consumer sentiment. Pay attention, particularly for B2B firms, to the increase in taxes. All of this has been discussed. None of it has been written down on paper and actually certified and legislated in the Duma, but this is all on the agenda and is likely to come into place in some form, these various taxes. Most of this does fall on the mining sector and just in general on the business sector, but importantly, there are some other taxes coming in that would impact consumers as well. So the higher insurance premiums for high incomes and the property tax raised. This would disproportionately impact, of course, wealthy consumers. So considering your portfolio of your segments and products within your portfolio, targeting those types of consumers.